Everyone trying to make money in this credit space is stuck choosing between two business models: credit repair or data furnishing. Most people pick credit repair because it seems easier to start, but there's something about the economics of these two models that nobody's really breaking down. One of these scales goes to 6 or 7 figures with the same amount of effort. The other one, it keeps you stuck trading time for money, no matter how hard you work. And the difference comes down to something most people don't understand about how these businesses actually operate. By the end of this video, you'll know exactly which model makes more money, why, and which one you should actually build. Section 1, how each business model actually works. What credit repair actually is, it's disputing inaccurate information on credit reports to get it removed. The model of this, to make money, you're charging clients monthly fees or for every time you delete something, once you delete it. Now let's walk through what data furnishing is. This is creating new trade lines that are positive, preferably that report to credit bureaus through bank partnerships. Let's explain data furnishing as the business model. Now, in the regulated way, which we're pushing forward in this 2026 era, it's software infrastructure that bridges banks and end users who need credit architecture. Now, the key difference between credit repair and data furnishing is credit repair is fixing what's broken, while data furnishing is building what's missing. By the way, if you're interested in building this data furnishing model the regulated way with legitimate bank partnerships, click the first link in the description to learn more. Section 2, which model makes more money and why? To walk through the revenue of a credit repair business, typically every month, and this is the top 1%, they're charging $50 up until $150 per client per month with manual work per client. Now let's explain what the problem is with this scaling. With credit repair, more clients means more work. Obviously you have automations and things, but you're still trading time for money. You can only handle so many clients before you need staff, and you need more and more staff. Now with the revenue of data furnishing, you have platform fees. You get money off of subscription fees. You get money off of the percentage of each transaction that comes in through your platform with a scalable infrastructure to hold it and maintain that scale. Let's walk through and explain what's differently about the scale of a data furnishing business. The software, while it's also a software in credit repair, this is more efficient in handling operations. You're more hands-off, having banks handling the compliance for you on your behalf. You're focusing on the acquisition of end users rather than doing everything, including the compliance, making sure everything's legal. You're doing just the acquisition of the users to your platform. Now let's break down with the math and see what's really going on with the revenue. Credit repair, this might cap at around 20 to 50K per month with the team. You might make a little bit more with the team, but let's go into data furnishing. Data furnishing, you can scale to 6 or 7 figures with very, very efficient work using the same infrastructure. Now, the margin difference of profit between the two businesses, credit repair, it has ongoing labor costs. Data furnishing, it has mostly fixed costs that don't increase as users increase. The credit repair math, 100 clients times $100 per month. That's 10K revenue minus labor costs. Now, when we move on and shift to data furnishing math, 1,000 users times $50 a month. That's 50K in revenue with minimum additional costs. Section number 3, which one you should actually start and when. Now, the model that's easier to start, it's the clear-cut winner, credit repair. It requires less capital, it's simpler setups, and you can start that as soon as today. Walking through, let's say when you're doing that, what it requires to launch. It's basic knowledge of FCRA, disputing letters, templates, easy to grab acquisition of clients. Now, let's talk about the launch of data furnishing, software infrastructure, bank partnerships, compliance frameworks, and it's a 60-day to 90-day setup just to get everything on your end so you can pitch it to these banks to get things started. Now, what makes sense when you're talking credit repair, you need cash flow now. Look, service-based businesses, you're okay with doing the work, starting out with manual labor, learning the industry first. This is recommended. If you want to go do the data furniture route, if you're trying to build real infrastructure here, you're willing to invest upfront a significant amount. You want something that actually scales. Now let's break down this approach in the hybrid method. You want to start with credit repair to generate cash flow, learn the market, and then transition to data furnishing once you understand this finance space. The truth is, credit repair, it isn't a bad business. It's just a different business. If you need cash flow in the next 30 days and you're comfortable with client service work, it's a solid choice. But if you're trying to build something that generates 6 or 7 figures without scaling your team proportionally, data furnishing is the only business model that gets you there. The real move is understanding which stage you're in right now and picking the model that matches where you're trying to go. If you want help building the data furnishing model with legitimate bank partnerships, click that first link in the description to learn more. Peace.